Happy New Year, yeah, nice to be back with you. And we're going to kick off our 7th year of doing this with you with some financial education events. So today we're going to talk about the markets. We're going to have Ian starting us off, then Dave, then we'll have a panel. But before I get to that, a couple of housekeeping things. Food's back there, drinks back there, restrooms all the way in the back. So this isn't church or school, so you can just get up and do what you need. Just because I heard one, but if you want to silence your phones as we get into this, don't worry, Tom, I got you. You can silence your phones, or if you need to take a phone call, just head to the back, that'd be great with everything else. And for those that have been here, know that we like to kick things off a little bit of trivia before we get into the main event. And we're talking stock market, so I thought I'd rather do trivia on the stock markets. I know we have a mid-election year coming up, but I didn't want to do any election trivia. So, here we go. Where was the first U.S. stock market? Where was the first U.S. stock market? Philadelphia, that's correct, 1790. When was the New York Stock Exchange founded? When was the New York Stock Exchange founded? No, not 1923, not 1520, 2 years later, 1792, from Philadelphia. And the first company listed on the New York Stock Exchange? Bank of New York. We were just talking about banks, right? Oh, everybody likes banks. All right, so a little bit of trivia for you. I'm going to introduce the speaker. We finally got him here. He had a little bit of trouble getting out of Charlotte with the big snowstorm. They have more snow in the Mid-Atlantic than we have here, but we're happy he's here. Ian is a big South Carolina fan. That's his undergrad, and master's from Citadel. Also has a CMT designation. Been navigating markets for coming up on 10 years. So without further ado, father, and do you have a new haircut?
I have a new haircut.
Yeah. No, and also a Chiefs fan, so he's loving the playoffs right now. Hey. All right, so how about a big round of applause for Ian McMillan.
So good to see you guys to kick off 2022. So I'm going to talk to you a little bit about 2022, the start to 2022, things that we can garner from a few time periods around Christmas and January in particular. And then David is going to give a little recap of 2021 and some things to look forward to in 2022. Always we have to put the legal notifications out there. Anything that is presented on today is strictly for informational purposes. We have clients, some of you are clients, some of you are not. We are aware of the risk that our clients are wanting to take. So things that are discussed, again, may or may not be relevant or proper for your particular investing. So always something we want to get out of the way first. Usually Dave kicks these off and he starts off with some family pictures. Unfortunately, you will not get to hear Dave's story about watermelon for the 15th time today. I'm going to talk a little bit about my family. So as Paul mentioned, I went to the University of South Carolina. My wife and I are very, very big college football fans. It's something that we take very seriously. So a very fun, football in general, season is a very fun time. So just a couple picks. Recently, we went to a bowl game, North Carolina versus South Carolina. Came to town. The Duke's Mayo Bowl was December 30th. Dave was nice enough to let me off work that Friday. So we got to, stadium's only about 15 minutes from our house, so it was really convenient to get over there. They did win. They were favored to lose by 17. They won by 21. So it was a great, great day. And then, yes, so Another thing that is very important to me, a big thing that has happened in my life, so I have a 2.5-year-old son. So this Christmas was like the first Christmas that he actually understood Santa and presents and coming down the chimney. So this is just a picture that Santa comes to his daycare, parents were allowed to come. So that was, this past Christmas holiday season was an extremely fun time for us, and getting to watch him experience all the new excitement that is Santa Claus and presents and all that attention. And then this past year I actually wrote a children's book. It was recently published. We've worked on it actually since 2020, and got put on hiatus a little bit in 2021 with work and the way markets were, and that took a little bit more concentration and time. But late last year, finally got it done and published. So it is it's called What is a Stock? And it's not just about technical analysis. It's about, you know, different things and the adventure a young boy has with his father and learning about investing. So that was pretty cool, and I dedicated it to my son, Connor. I wrote it while my wife was pregnant with him. And so to kind of see it come to fruition is really cool. But all right, back to what you guys are here for today. We're going to talk seasonality, Santa Claus. We just talked a little bit about Santa Claus and the power of January. We're going to talk about midterm elections and the market impact. 2021, the year in review. What's our game plan for 2022? And then, of course, as always, we like to do a Q&A panel. At the end, Paul will ask Dave and I some questions, and we'll go through charts and some bigger topics. And then, obviously, housekeeping and final thoughts for Climb First as a whole. So, again, Santa Claus, not necessarily the Santa Claus that my son likes to talk about, but the Santa Claus rally is the last 5 trading days of December and the first 2 trading days of January. So, historically, this 7-day period, and I believe this was December 23rd this year it started, and it ended on January 3rd. If this period of time is bullish, it's positive, then that is usually nothing that we do in this industry is 100% for certain, but it can be a good barometer as to what stocks will do the coming year. A few more stats on here. So we've had a few flat years, but again, most of the time, it's a very good, like I said, barometer of things to come. If Santa should fail to call, bears may come too broad and wall. It's a very popular quote this time of year, kind of in the investments industry, as everyone waits to see how bullish January is going to be. So, our answer, how was Santa Claus rally this year? It was positive, up 1.43%. It's very good. It's exactly what we want to see. There's a small caveat there that the majority of those gains came on the very first day. I think it was December 23rd, and we were kind of flat to negative the rest, but that is not the point. The point is we were positive. It doesn't matter how we got there. It's the fact that we were positive. All right, so we're going to move on and talk about the whole month of January. And January typically is seen as what should be a bullish month, particularly if the year before was, right? So people just got through the end of the year. Stocks were good to them the year before. They probably got a bonus coming in. Maybe they're amping up their equity allocation in their 401k. So when good things happen, we like to see that continue. We want to see investors say, yeah, I want to continue owning stocks for another year. Because a lot of people, right, they only make these decisions, you know, at the beginning of the year, maybe every 6 months. but this is the time of year when big decisions are made, big allocations, and we would like to see assets coming into the market during January with people feeling positive about the next 11 months versus people taking money out of the market. Again, so nothing that we talk about, correlation does not mean causation. This is not anything perfect, but it does give us, can give us a good idea about what's to come. So we have a few things here. We have the first 5 days of January. 37 of the last 43 years. When the first 5 days of January are up, the average gain for the S&P that year was 15%. That's very good. That's almost double the historical average. Now, when it's negative, does that mean that stocks are down for the year? Again, not necessarily. It's about 50-50. And when it is negative, the annual return is basically flat. So below average, not what we want to see. It doesn't necessarily mean that we're going to enter a bear market or that it's going to be a horrible year, but it does give kind of that lethargic feeling to the year as a whole. So what do we see in the first 5 days of January this year? 2022 S&P down almost 2%. Not what we want to see. So moving on to the bigger picture of the full month of January. So when we were looking at the full month, going back to 1950, every time that the market was down during January, besides once, preceded a flat market, a 10% correction, or an extended bear market. So 2016, we did not have a great January. Nothing too bad happened that year. But typically when we do have one, there's something waiting in the weeds for us. It doesn't mean it's coming in February. It doesn't mean it's coming in March. But that typically means there's some type of monster out there waiting to take over the market. And we better be on the lookout. So when the S&P is positive in January, history says that the rest of the year will be pretty good. So again, going back to 1950 is a pretty good track record. So 90%, almost 90% of the time, when we're up this month, we typically have a pretty good year. So we want to see January. We want to see investors act bullish when they should be acting bullish. So we've got Santa Claus rally. The first 5 days in the January barometer. This is referred to as the January trifecta. I know Santa Claus kind of goes into December of the previous year a little bit. So when we get all three of these time periods positive, for a full year return was also positive 93% of the time with an average gain of almost 18%. So again, a very above average return when we get these confluences of positive momentum. So how is the January barometer looking so far in 22? Not great. So as of yesterday's close, and the market was down again today before I walked up here. So down about 4% so far with, I don't know, maybe 8 trading days to go. So it's got some work to do if we are going to thwart the bearish information that we're getting right now. But to be decided. All right, so midterm elections. I know you guys came here and really wanted to talk about politics because I'm sure you don't get it enough in the rest of your everyday lives. So I'm glad I can do that for you today. But if you've been to the Lunch and Learns before, if you listen to the podcast, you know that Dave and I are, while we are very opinionated when it comes to politics, like most of us, it does not play a role in our investment process that we have with Adaptiv. As much as common sense says things should happen, and clearly I'm right. Even if I think it should play a role, like I've just also seen too many times where you think someone's bad for something and they're not, or you think someone's good for this industry and they're not. And it's a way better approach to remove politics from the equation altogether. We're going to talk about midterm elections, right? So right now, 50% Republicans, or 50 Republicans and 50 Democrats in the Senate. All right. House of Representatives, also pretty close, right? This is a pretty bifurcated political system that we have in Washington right now. So midterm election years, typically a lot more volatile than your average year. There's a lot of angst going into whether it's a midterm or an election year. But people and investors have a very hard time wanting to put money to work when they know that the landscape could change pretty quickly in the coming months. So as a whole, midterm election years typically underperform your average year. They are also more volatility, and that volatility typically will pick up in this summer. And that's just because of the uncertainty. Investors hate uncertainty. No one wants to put billions of dollars to work in an idea or a sector or an industry if the politicians coming in are going to change the landscape of their investment thesis. So we typically see in midterm years the market have a correction, but once that dust is settled, we know who's going to be in charge. Investors can move forward because we got rid of some of that uncertainty. So as you will see, this is going back to 62, and we've got 14 in here. We don't have 2018, but you can see the mid-year correction, typically pretty decent, typically at least double digits. And then you see the performance following that correction. As investors they have their new information, what a politician is going to be good for this sector, this industry, and they can move forward. And again, we see the S&P returns for midterm elections where the House majority switched parties. So lots of volatility early here, May through the last half of the year. Once we get through November and into January and into 2023, things typically should pick back up. But on average, again, we just want to talk about historically on average, there is lots of uncertainty and fear and not a lot of conviction when it comes to stocks in the first half of a midterm election year. This chart I know we shared back in 2020 as well. So we talk about which party is better. And I said the same thing in 2020, and I'll tell you now, there is no one in this room that wishes that their political party was better for the stock market. I wish I could go and say that. But they're not. Neither party is any better for the stock market when we go back 170 years. So there you have it. That is our thesis on why politics, as much as Dave and I love to talk about politics on a personal level, sitting back and have a beer and talk about who's better or who's worse, it just doesn't fit into what we do. And with that, I will hand it over to my man Dave.
Great job, Ian. Why don't you guys give a round of applause for Ian? I thought you did a good job. And truth be told, we probably talk more politics than we do watermelon. Although talking with my daughter Ava, that's her favorite food, she really wouldn't like to talk about politics very much. But Ian, great job. Thanks for walking us through our biases a little bit. We all have them, right? And we especially marry them. Even if you think about the vaccine question, right? there's something called an endowment effect, where when you purchase a car, you believe that that was the best purchase ever made because it was the purchase that you made, even if the car turns out to be a lemon. So some people chose to get the vaccine, and so they read all the information that they can get that prove that their decision was correct. Same with those who are unvaccinated. They read all the things that prove that their decision is correct about being unvaccinated. Where I would like us to get to is, if you got vaccinated, great. If you didn't get vaccinated, great. Same thing with politics. In the end, there is only one in control. It's not Republicans, it's not Democrats, it's the Lord. We keep that in mind, things go a lot better. So with that, I want to jump into 2021 and 2022. First thing I want to start with is the word bifurcation. It's a very fancy word. If a little kid said it, sometimes moms would be like, "What did you say to me?" So bifurcation is a fancy way of saying there's two things completely different happening at once. And that's what we had going on in 2021 in the stock market. Two different things going on. My wife and I had a chance to go to Mexico recently, and we wore polarized sunglasses. Yes, because of the sun, but it was also nice because we were in a spot where there were a lot of fish. We could stand on the shore and you could just see fish in the water everywhere. That's a little bit how the adaptive system works. We're able to see the surface of the water, but we're also able to see what's going on underneath. And I kind of want to talk about something that was going on underneath in 2021. To start with, the three indices I have up here, very popular: S&P 500, NASDAQ 100, Russell 2000, right? We got 505, right? That's a fun fact you can share with your friends at the next birthday party. You know, the S&P 500 is actually 505 stocks. NASDAQ 100, actually 100 stocks, Russell 2000, 2000 stocks. You'll notice that the S&P 500 and NASDAQ did one thing for the majority of the year, which is go from lower left to upper right. Well, the the Russell 2000 since February did nothing. Just moved sideways, nothing but a hot mess. So that's two different things going on at the same time. We've got large caps rising higher. We've got small caps in a hot mess moving sideways. And I want you to remember what I just said about February and March 2021. As we move forward through these slides, I want you to look at what's on the charts and where they start in February and March of 2021. Here's another example of what happened in 2021. Again, S&P 500 up, NASDAQ 100 up, Russell 2000 flat from February on. These are two other measurements: value line, geometric index. It's a formula that runs and is rebalanced daily. It gives you an idea what the average stock is getting for an average return. Did nothing since March of 2021. Same thing with Wilshire 4,500, 4,500 stocks. It's a lot of stocks representing all stocks. Did nothing since February 2021. This is where I want to highlight our process using the adaptive system. When we look at positions in the portfolio or things that are being considered for our client's portfolio, we're always going to be looking at risk reward, identifying trend, and there's different trends. There's uptrends, downtrends, but I just highlighted there's also sideways. There's nothing. Trendlessness. We're going to manage risk using weight of evidence, and we're going to stay disciplined in that process with the three main objectives being big wins, small losses. Number 4 that's missing is the big loss. So some of the things I'm going to go through here are some of the things that were happening underneath the surface that we did not participate in. So in this table here, we have the major indices I listed before. This is as of November of last year. We look at from in these indices, so S&P 500, we followed over. We look at percent of members with at least a minus 10% drawdown. So we had a 10% correction of 90% of the S&P 500 underneath the surface happening during 2021. The average member drawdown happening inside the S&P 500 was minus 19%. Inside the NASDAQ, 41. Inside the Russell 2000, 37%. How is this possible? The index is going up. Because 5 stocks, your big ones, your Apple, your Microsoft, your Amazon, those were actually not having those type of drawdowns. Then when we look at these massive returning areas of the market from the prior year, what did they do this year? So a very popular ETF is ARK Innovation. At one point had upwards of $800 million in it. Down 52% since February of last year. Clean energy, down almost 57% since February of last year. Now, I want you to think about some of this. Who was just elected? President Biden. Where does our bias fit with this? Biden's supposed to be good for clean energy, correct? Okay? Biases are trouble. We don't let those in the portfolio either. Cannabis. Biden's administration was supposed to be friendly to marijuana. Minus 65% since February. Again, notice I'm talking about February and March of last year. Software. Now this one's a little more, I don't think this has a bias to it. I don't think there's one party that's married to software and one that's not. But again, since February and March of last year, down 41%. Again, things that are not in our client's portfolio, because from this point, they're going from upper left to lower right. Sellers have control. Another big story from last year is the aggregate bond index. So this index tracks all the different credit instruments. So it could be treasuries, it could be short duration bonds, it could be corporates, it could be junk bonds. All those things are in the aggregate bond complex. What's interesting is, for the second year ever, the total return for the aggregate bond index was negative. What does that mean? So a total return means, what did the asset itself return, plus the dividends and yield that it received during the year. So the combination of it actually depreciated enough that exceeded to the downside the amount of yield paid to it. So think about that. You had a bear market underneath the surface, and they sold bonds. Since the late 80s, now it's been going on since the 80s, but the reason why the 60-40 portfolio, 60% stocks, 40% bonds, came into existence was that the idea is when stocks correct, bonds hold the portfolio up. They rise and they provide some yield. They have a negative correlation. That went out of correlation this year, and I think that's a big development as far as what we're going to see going into the future. Because interest rate cycles tend to be 35 to 40 years long. We're at that point right now, somewhere in this window, we're going to see the bottom in rates take place. I can't guarantee that, of course. They could go, I suppose we could have negative rates for the next 20 years. But the 60-40 portfolio dies when this happens, right? Because 60-40 portfolio works when bond prices are rising and rates are dropping. The 60-40 portfolio dies when bonds are falling. And that's what we're starting to see. That's why we don't marry the 60-40 portfolio, we manage adaptively. We don't have to own all bonds, we don't have to own bonds at all. So this gives you a flavor, this chart gives you a flavor of the average stock during last year. The average bond was actually negative. Long-term treasuries, negative. Performance for last year, moving left to right to give you a flavor. You've got the S&P 500, Dow Jones, NASDAQ, Russell 2000. These next four are models. These are all net of fees, so after fees. Adaptive Ultra Growth, Growth, Moderate, and Balanced. Here's our growth benchmark, 60-40 benchmark, balanced benchmark, and then what aggregate bonds did. So some beat, some did not. We're not necessarily in the business of beating the S&P 500 except for one of our models. But this gives you a nice flavor. There's a disclaimer at the bottom. Kevin did a nice job putting this together for us, so it's appreciated. Now, our 2022 game plan. Everybody remembers this guy, right? Rest in peace, John Madden. I was gonna try to do this whole shtick where I tried to draw up a play and talk like him, but no one can do it like he can do it. Maybe bring up a turducken. But before we get into 2022, one of the things that happens this time of year is, and in fact, and I won't point this person out, you get asked, what do you think is going to happen? What do you think is going to happen this year? And we see it on CNBC all the time. Everybody gets up there and gives their predictions on where the S&P 500 is going to be, where Dow Jones is going to be, yada, yada, yada. The fascinating part about that is A, they don't know. B, I don't know. C, no one ever holds them accountable when they get it wrong. Right? You get to the end of the year, and they never talk to the guy who said, yeah, we're going to be up 7%, we're actually down 10. Guess what? He's back on TV in January, talking the same smoke that he was before, and we just take it. We need to grow up as far as the way we consume information. Hold people accountable. We don't need to make predictions, and that's why I put this on here. There's a big, big difference between talking on TV and actually managing money. Okay, anybody can get on TV and say what they want to say, because predictions make us feel good, right? If I tell you the S&P 500 is going to be up 10% this year, that makes you feel good. There's a false incentive then, right? Because why would I ever want to tell my client I think it might be down? Or get on TV and tell someone I think it might be down. That makes people feel bad. Media is not in the business of feelings, they're in the business of selling you things. They want their eyeballs on the screen. So the difference is the pundit wants to make a prediction. That's not our process. We need to have a plan. The professional needs to have a plan. So what is our plan going into 2022? We had a stealth bear market in 2021. What are we going to do in 2022? What's our game plan for our clients? Let's start with S&P 500, most popular index on the planet. Best performing index since 2009. Very simple. And I should highlight here that these charts are as of like 9 a.m. this morning. And a lot of credit should be given to our client experience team, Sarah, Heather, and Renee. I gave this to them at like 10 and they had it ready for our noon session. We had 120 people here, so if you can imagine having to have that many things printed, and they just did a great job. So I will try to update the price on this as we go along, because we had closing prices this afternoon. In fact, we're at 45.32, I believe, right now in the S&P 500. If you're a client, you're already familiar with that we've been reducing exposure already. But below 45.30, that's a little bit of a yellow flag, if you will. Below 42.75 would be a red flag. We don't want to have anything to do with stocks. NASDAQ 100, we've already breached an important level, 380. 350 looks like a magnet. And you can take these home, that's fine. You can look at them, track them along when you're hopefully not watching CNBC, but maybe you're looking on your computer and seeing where price is at, these different things. 350, if we're below that, we want nothing to do with large cap tech growth stocks. Russell 2000, we've already made an important breach. In fact, we're lower than this price today. I think we're at like 205, but 209 is, we're below an important level. We don't want to be, and the thing I want to point out about this is this is almost a year long. So the way to think about having a plan is very similar to a quarterback, right? Everybody's gonna watch the Packers on Saturday, right? Maybe? Okay. So one of the things a quarterback does, or the offense does, that many people you don't get to see on TV is you're really isolating one or two players on defense that you're gonna pick on. And when the quarterback drops back, he's just looking at those two people. And he's making a decision based on what those two people do. So for example, if I have my tight end going out, doing a curl route, and I've got my running back out this way, I'm picking on the linebacker, because he's got to pick someone to cover. If he covers my tight end, I throw the running back. If he covers my running back, I throw the tight end. Same thing in markets. If we're below 209, I want nothing to do with small caps. Why? Why do I need to be involved with downtrends? If we're above 209, we can be involved, no problem. Even better, if we're above this consolidation, 234, we will get aggressive, right? If the safety bites, we're gonna go deep. Same thing in markets. It's all binary thinking. If this, then that. Microcaps, we're below 136, red flag. This is also a good indicator of risk on, risk off behavior. So as an asset manager, if you're willing to take a risk, do you go in the safe blue chip large cap names? Or do you go in the really aggressive, non-profitable small cap names? Really micro small cap names? You go here. This is where you go when you want to get big returns and take risk. This is risk off. The fact that we're breaking below this, and this has been leading the whole time. I'm not saying that that happens with the rest of the market, but below 136, that's a problem. We are not involved with microcaps. In fact, I should point out, in full disclosure, we are short small caps. All world ex-US, so this represents total world stocks, and then you subtract out the US. So this gives you a flavor of what's going on internationally. 59 on this instrument, extremely important. We were lower again today. Will we breach that? I have no idea. Above 59, not a bad thing. Above 64, awesome. Let's get aggressive, let's participate. Below 59, let's have nothing to do with it. Total world index, this represents approximately 10,000 constituents, so it's really good representation of what's going on with all stocks across the planet. 101, very important level. We were lower again today, but 101, that needs to hold. We'd like to see that hold to confirm risk on type behavior. Below 101, again, that's that option play. We don't need to be involved. Above 101, we can be involved. Treasuries, this is a big one. This goes back to the 60-40 portfolio I was talking about. So when treasuries fall in price, rates rise, vice versa. When treasuries rise, rates drop. This 135 level, extremely important. If we breach that, higher rates across the board. And we're seeing rates rapidly advance currently across short duration. So anything, it could be less than 2 years in duration, which just means like what's the length of the instrument. These are 20 plus years in instruments, and so we see rates rising across the board. It is our belief that the Fed does not set the rate, they respond to the market. The rate that's being set by the market. And right now the Fed is behind. We're seeing rates quickly rise, and the Fed has not raised yet. In my personal opinion, if I was a fundamentalist, which I'm not, the Fed should be out there tomorrow raising rates, but they're not. We'll see what that means in the future. I have no idea. But we want to see 135 hold to be involved with treasuries. Again, treasuries is a main component of a 60-40 portfolio. If 135 is breached, that means the 40% is falling inside of a portfolio. Aggregate bonds, again, this represents bonds across the complex, junk bonds, high yield bonds, corporate bonds, any credit instrument you can think of, that's what this represents. It is on the brink, right here. If this breaks, it means higher rates across the board, and that has ramifications. 111, we want to see that hold. Above that, no problem. Commodities, you'll notice something different, right? So equities, I'm talking about price levels that have to hold. Treasuries, bonds, I'm talking about levels that have to hold. Commodities, we're breaking to new highs we haven't seen since 2014. We're involved with commodities. We own some oil, we own some agriculture, we own some tin. We want to be involved with these things. Specifically energy. Energy going out to brand new highs. Energy commodities would be oil, natural gas. Fun fact, do you guys know what the number one performing commodity was in last year, 2021? Anybody want to take a guess? Coal. Charlotte's got it, she wins. How's that fit the narrative? Clean energy down, coal up during a Biden presidency. Doesn't match, does it? That's why we cannot use biases and narratives for our investment process. Energy commodities up, we're involved. We like energy commodities as long as they're above 118 in this particular instrument. So with that, I'm gonna get Paul and Ian to hustle up here. They're over there eating some of the good food that's here, finishing off their drinks, and that's good.
All right, we're gonna get the panel session going here while Dave's getting set up. So, as you know, the team does a ton of research, right? You can see the stuff that's above kind of the water line, also a lot of stuff that's below the water line. And so, with Pratty and Kevin and Ian and yourself, Dave, seeing a lot of different data, seeing a lot of different past tendencies, I do want to catch up on seasonal tendencies. Any headwinds or tailwinds that you guys are seeing?
So, we talked a little bit about midterm election years in the stock market earlier. This was the graphic I was referring to that gives a little bit better of a visual of what a midterm year looks like versus a quote-unquote average year for the S&P. So the purplish blue line, I don't know what it is on the handouts, but it's purplish blue up here. Typically a pretty solid uptrend. There's, summer months a little bit more volatile. All right, we talked before at lunch and learned about October through February, which is or November through March, which is kind of that period is typically seen through as the most five bullish months of the year. But as you see in the dark blue year, midterm election years are quite a bit more volatile. Pretty rough start. As you can see in January, we typically have that has followed through so far in 2022. And the summers usually get pretty rough. So lots of uncertainty. Like I said, investors hate uncertainty. So on average, starting at about May or June, this kind of starts in April, but about that time, you will start to see volatility pick up, and it gets a little bit better in October and November. That's when you will start to see, on average, markets and start to pick up as the winners of the election become more clear. And then as you see November, December, usually pretty strong for stocks as everyone places their new bets based on who's in office.
All right, next question I want to go to, you've seen a lot of headlines, supply chain, right? You've seen the pictures out of LA where people are just robbing trains, maybe on a personal level where like things you used to see in the store readily stocked aren't there. Maybe you're trying to get a car repair done and all of a sudden, oh yeah, tires are going to be, a couple of weeks lead time. So I want to touch base on supply chain and how that's affecting the markets.
I think that's a good question. I guess, we had some good discussion about this in the noon lunch hour, and I guess I'm curious if we can make this a little more interactive. Any of you experiencing anything supply chain related, whether it's with your job, whether it's with the things you shop for? Guy.
No, this has never happened to me, never. I've been on these medications for cholesterol and high blood pressure, and I went to reorder an Optimum, which is United Healthcare.
Oh, yeah.
They said out of stock.
Really?
Wow.
I mean, I never had that.
So is your regular medication for
Just
these
the regular
cholesterol out of stock?
high blood pressure
Okay.
stuff, out of
Oh,
stock.
my.
Wow.
We have the same thing.
I saw more hands.
Medication to be optic. That's what
Go ahead.
I had some too. He couldn't.
I ordered a range hood, and they told me it was gonna be here last week, and at the beginning of the week, and when I didn't get it on Friday, I called on Friday, and they said, oh, yeah, well, it's somewhere on a truck, and it might be here next week, but we can't guarantee it, because we can't tell you where the truck is.
Oh, that,
Okay.
yeah.
So the truck has your range hood somewhere.
Somewhere in America.
Somewhere in
your
America.
product on the
Yeah.
truck.
Anyone else?
I had two pills that.
These things
were
are
out of
critical,
stock.
but, at school we use a lot of toner, and all of a sudden the toner guy says, we can't get toner. It's a, Minolta, comes across the seas, There's no Minolta toner available right now for certain kinds
Oh,
of printers.
jeez.
So no toner.
Yeah,
Now,
okay, makes sense.
kind of a story related to that. Our client experience team, another shout out to them, Sarah and Heather. We recognized some of this was happening. They made sure they ordered enough paper for tax season. That was already in summer, just to make sure they had it. I saw another hand up here.
Yeah, just building materials.
Yeah.
Was talking to a contractor today, windows are 20 weeks out.
Windows are 20 weeks out. Wow. Okay. Go ahead.
On the window comment, I ordered 30 windows in October. They were supposed to be in the beginning of January. The clips for the window when they turn forward for a
Yeah.
double hung window,
Yeah.
that's what they're waiting for. They're on a barge somewhere. I was told.
Barge somewhere.
On a
Wow.
barge, on a truck.
Yeah.
They're
Yeah.
somewhere, right?
Windows?
Our
Yeah.
products are all somewhere.
They're all somewhere. And so, like, an example for me, went to Emily's parents for Christmas. My oldest son wanted to cook dinner one night, which was absolutely fantastic that he wanted to do this. So we wanted to support this event. Went to the local grocery store to get just some ground chuck for the burgers.
Basic ground beef.
No meat. The place had zero meat. And it was like a legit, like, pick and save grocery store. No meat. Other thing is, I'm running low on t-shirts, guys. I went to the Kohl's and I can't find t-shirts. So the supply chain thing is real. It's amplified by even this weekend with the vax mandates that are coming in for the truckers. There's 35,000 containers that will not be making transportation back and forth over the Canadian border. So the goods from Canada aren't coming here and the goods from here aren't going to Canada, 35,000 loads worth. Because those people don't want to get vaccinated. And so that's only going to amplify things. The trucking thing seems to be a consistent theme. Same thing with the ports when you say something's on a barge.
Yeah.
It really has to do with they can't get trucks in these ports fast enough to get the containers out of the ports. So it's a real world issue and problem. And when we talk about markets, I think sometimes we forget that they're future discounting mechanisms. They look 6 to 12 months into the future and diagnose, put the bets on the table on what they think that's going to look like in 6 to 12 months. Well, you'll remember what I talked about with February, March of last year. We saw a lot of things start to correct underneath the surface from February, March of last year. Was that supply chain? I have no idea. Was it the rollout of the vaccine? I have no idea. Was it a barge getting stuck in the Suez Canal for 3 to 4 days that also hampered supply chain? Was that it? We don't know, but what I do know for markets is that the supply chain thing becomes an issue for the market. I'm saying it's an issue because we're all experiencing it personally, but for the market, we'll know it's a real issue if we're below those levels that I provided in those charts. So take those charts home. You'll be able to follow along and see whether that's really going to be an issue for the market.
So let's talk about the charts, right? We haven't had a correction over 10% since I believe March of 2020, right? We had a big V that happened. So are we due for another big one?
Obviously, like I said this afternoon, saying that anything is due is a pretty dangerous territory to get into, right? That team's due to win a game, or a baseball player's got it. He's 0 for 20 and he's due for a hit. Especially when it comes to managing, and being responsible for our clients' assets and their net worth, making a decision based on, it's been so long, it's got to happen soon, is not a real practical approach. I would say the signs have been there, right? If we look back and we saw the cracks in the foundation throughout 2021, but it was easy for your average investor to gloss over because when they checked their statement at the end of the month, right? If you're in the S&P and you're just indexing, you're not out there involved in a lot of these individual stocks. It was a pretty basic year, not a lot of volatility. Did we even have a 5% correction? Maybe 5%. Maybe like the NASDAQ had a 5%, but a very low volatile year. The last time we saw that was 2017. Two very, very different low volatility years, but the same kind of result for at least the S&P at the end. So is the market due? I would say going back to those levels that Dave talked about. We talked about the Russell. I mean, the Russell has broken down. So if it's going to happen, we will start to see it unfold. The red flags have been there. The red flags continue to build. Now you're starting to see some of the strongest names kind of fall off a cliff one by one. Not to use dramatic terminology, but I mean, the big soldiers are kind of starting to fall. And it's what would happen. I would say if we were going to see a large correction, the things that would have to happen have started to happen. Now, could they reverse? Absolutely. I mean, we could be here in April totally with a totally different outlook.
Ian and I are probably two of the most positive people when it comes, like, if you've been to enough of our presentations, you realize we're generally bullish, but that's because price is telling us to be bullish. And this is probably the most bearish, which means the most negative we've been.
I would say skeptical.
Skeptical
is
in a
very
long
good
time.
word, yeah.
We are willing to be wrong though, meaning that if we're above those levels on those previous slides, that thesis of a lower market is wrong. It's just a fact, right? If price is moving higher,
You don't sit there and say, oh,
marry
I'm still
the
right.
bear market. I married my wife. I didn't marry my opinions. So that's the way we want to, manage money. Is that when we're above certain levels, we want to participate. Below, we don't. Go ahead.
You had a lot of data early on in the presentation about history, and the one aspect that you didn't mention, I'm curious if you have any data on, is we've had the highest rate of inflation in decades this year. What does the stock market tend to do after that type of a scenario? You must have some statistical data to suggest what happens when you have runaway inflation or accelerated inflation. How does the stock market typically react?
Okay, so his question is about when we see inflation, what does that look like from a stock market perspective? And I'm going to wander around that a lot in what I'm about to say. So, fair warning. What I find fascinating is about a year ago, the government was telling us in headlines that there was no inflation. And now we just had headlines about should the government step in and control gas and food prices. That is two very different things. So we need to stop using media and stop using the government to make our investment decisions. Two, what's interesting about where we are right now and I would agree that we are seeing inflationary things in commodities, tin, aluminum, cotton, oil, what am I missing? Corn, a lot of the grains. A lot of the grains are making generational moves right now, which we're happy for farmers, lumber, but these are all inflationary. The rates are starting to match this, right? We typically see rising rates in an inflationary environment. We also tend to see, in the beginning of an inflationary phase, stocks do well. And we're open to the idea that stocks continue to do well for a little while. But again, if they're below those important levels, there does become a point where certain companies can't operate in a high rate environment. What do I mean by that? From a fundamental perspective, if you're a company that's run on credit, so maybe your profit is not a lot, you're using a lot of credit to fund your operations, payroll, your projects, all those things, and you've got to revolve that debt into new debt that's more expensive, your company becomes less viable. So eventually it does catch up. Higher rates, the higher they go, does impact a part of this scenario where some stocks don't do well. On the flip side, some stocks do, like financials should do well in a rising rate environment. Now, it's information recently, we've seen rates rise and now we've started to see financials falter. That's another red flag. So I wandered a lot of places and I didn't give you like specific data, but I gave you some generalities that I hope, did that answer a little bit?
Not really.
No, that's fair. I don't have like concrete data like.
I'm just curious, what if you know, I don't want to belabor the
Inflation isn't necessarily bad for
what
stocks.
happened to the stock market, let's say after 17% interest rate regime,
Sure. So one of the interesting things, going back to my comment about 35 to 4-year cycle and rates, is the bull market in stocks took off at the end of the last cycle. So the 17-18% mortgages were happening in the late 70s and early 80s. One of the best bull markets happened after that point in time, but that happened because bonds started to rise and rates started to fall. There are periods of what would be called stagflation, right? The 70s was a big stagflation period, and that can happen again where stocks kind of do nothing, commodities do a lot, and rates rise. So the 70s would be a great place to look to see what happens when rates get away from us, inflation gets away from us to a point where it affects stocks. Great question.
That was a really good question. We'll do one more question from the crowd. We're gonna start wrapping things up. Go ahead, Guy.
At the last presentation, you guys, you were talking about, you particularly were watching the Russell 2000 small caps. Do you remember why you were watching that? Because obviously that's done.
Yeah, so I would say, Guy asked, at the last presentation, we talked about the Russell 2000, and why specifically do we talk about the Russell 2000? Dave talked about the S&P and the NASDAQ, right? We talked about how the S&P and the NASDAQ are very overweight in these large cap stocks, your Apples, your Amazons, your Googles, your Netflix. So the Russell 2000 is 2,000 stocks, and it gives us a much better view of what the average stock is doing. It encompasses a lot more. It's a lot more equally. They all have cover the same sectors, but it's a lot more equally weighted. Covers things like regional banks. It covers things like biotech and energy, more cyclical areas of the market. And so compared to the S&P and the NASDAQ, the Russell shows kind of what's really going on with the average stock. It tells a much better story than an index that is really dependent on basically 3 stocks that make up the top 25%. They can hide a lot of damage as long as Apple and Microsoft don't falter. There's a lot of damage that can be hidden, and a lot of damage that can be repaired very quickly by simply buying Apple and Microsoft. Meanwhile, the average stock out there that people own is just getting absolutely crushed, but you don't see that. If you're the investor that checks your statement at the end of the month, or maybe, each day at 3 o'clock you log in to see what the market close was, and you're like, hey, up a little bit, S&P's up a little bit, we're up 20% year to date, it can't be that bad, but much different story underneath. And that will, if it's bad enough and we're going to have a bear market, that will eventually catch up and start to spill over to everything else. I mean, you can't just hold everything up while the foundation's falling apart, and that's kind of what we've started to see.
Yeah, the only thing I would add is that this really ends in one of 2 ways. So the things that have been quote-unquote crushed underneath the surface, they're either going to bottom here and start to rise and everything rises together and we get another fantastic leg this year. Or we've gotten so bifurcated, we've had so many things go down while the indexes are up that eventually the indexes catch down. And we might be seeing the start of that now. I mean, the S&P is down almost 4.5% already starting year to date. Does that continue? We have no idea. But his point is, you have 2 different things happening. It only resolves in one of 2
The
ways.
Russell tells the true health of the market, and it doesn't get a lot of attention, but it's a much better depiction of.
So the question I have, because you do a lot of reading on it and so forth, is if we all go to cash and the inflation keeps going up, it's always been my impression, you sort of have to stay in the stock market, because where else are you gonna grow? And it sounds to me like you're going into commodities and energy, maybe you're in coal and things like that, but if you just stay in cash, you get further behind.
Yeah, so this Charlotte brings up, she's like, if you just hold cash, you get hurt by inflation. Should you could stay in the stock market. which does sometimes benefit from inflation. And your basic point is very valid. The reason why we're involved with markets, right? We're not, I say this all the time, we're not involved with markets because they're our friend. We're involved with markets because we need to maintain our purchasing power. We need to be able to afford those cholesterol drugs or whatever, lifestyle needs that we have when we retire. So for us using the data, the reason why we pivoted towards commodities is just because that's what the data says to do. The stocks have started to falter, and so we've started to reduce exposure in those and stayed participating in some commodities. Now, what's interesting from an inflationary standpoint is the inflation appears to be, or at least last year was happening a lot more overseas than here. And I'll use a simple metric. The dollar was up, the yuan was up, and that's it. All other currencies down, which is inflationary for that, wherever that currency is. So the dollar has maintained purchasing power internationally. Whether that continues or not, I have no idea. But your point is exactly true. You can't stick cash in a mattress and expect to keep up with inflation. It won't happen.
And I would add that some stocks can, obviously, financials, energy, staples like food producers, grocery stores. Like, there's been stocks that have done great during this. Unfortunately, those stocks that are waiting in the big indices, I think energy is like 3%. Energy could go up if ExxonMobil went up 200% this year. It's not going to make a dent in the S&P. And it's just where since 2009, that's just the market and tech and consumer discretionary have just so massively outperformed everything else that these other sectors, they can have great runs. Bank of America can be great. Banks can, be up 15% while the S&P's down because it doesn't move the needle like the tech companies do.
What I'll finish with, I was ending kind of with something I summarized already, is really we're in the business of managing risk or identifying the direction of the trend or trendlessness. In this case, S&P 500 technically is still an uptrend. Russell 2000 is not. Bifurcation continues. We want to manage risk using evidence. We want to stay disciplined and with three main outcomes, and that's our game plan for 2022. Take those sheets home. You can follow along our game plan. Above certain levels, we're going to participate. Below, we're not. These are not recommendations to you, especially if you're not a client, but it gives you a sense of how we think about things, with the three main objectives being big wins, small losses, cutting out number 4, big losses. So I really appreciate you guys being here tonight on a cold night, having a beverage with me, talking markets. This is my kind of night. Thank you.
How about a nice round of applause for Dave being in? So next month we'll be here. I will be talking about the latest trends and insights on consumer privacy and information security. Tons of scams, tons of things going on. I'll talk about that. We're in a new building. Our tax special is back. Some of you have gotten your organizers already. The rest of the batches are going out. So for those that have done their taxes with us, it's coming your way. For those that haven't, reach out to us. We're happy to help you. And with that, Dave talked about if you need any help, call our office. Love to help you out. With that, we'll adjourn. Enjoy. Thank you for coming. Enjoy the afternoon.